I actually received a comment from an individual in my DMs on Instagram who basically saw my trading today and said, Oliver, you're very consistent, but your risk management is horrible. I hope this is not what you're teaching your traders to do. Now, I told you a few weeks ago that I would be taking some of your interesting comments and questions and publicly addressing them, and this is another one that I would like to publicly address. First of all, I want all of you to understand that risk is relative to one's account. So without this person actually knowing my account size, that person can't possibly know how much I'm risking. So let me give it to you. I am risking on every single trade 0.002% of the capital I have available. That's right, 0.002%. Once that number is triggered or hit, I immediately close the trade. In fact, that's hard coded into my account. So without any human intervention on my part, once my maximum dollar amount is lost, my algorithms go into auto liquidation mode. So I don't even get an opportunity to eliminate the trades or my open positions. The algorithm does this not only for me, but for all of my traders. So a 0.002% risk on every single trade is incredibly small. That is a very, very small risk amount. But I also want to teach you something else connected to this question. This person went on to say, not only is your risk management horrible, in my opinion, you should be operating with a minimum of 2-to-1 risk reward ratio. Now, I responded by saying, sir, I appreciate your comment, but this is very, very novice. And I did not give him any detail because I wanted him to get the full response in my public response to all of you. So listen to this. The general theory in the novice world is that you're supposed to have a positive ratio, which means that you're supposed to win bigger than you lose. So your average losing trade is smaller than your average winning trade. Now, this is not necessarily a bad thing, but it is more appropriate for novices that have no consistency or skill to operate with a positive ratio. And if you've developed yourself into a consistent trader, it is best to use what is called an inverse relationship or an inverse ratio, which is your average loss is bigger than your average win. So let me give you an example. A positive ratio is you win $1 on average when you win, but you lose 25 cents on average when you lose. That's a positive ratio. Now, sounds good, right? Okay, cool. That is cool for traders that have no consistency. But if you become a consistent trader, that positive ratio will hurt you. You will be losing money. You'll lose money in the form of lost opportunities. Let me give you an example. Let's say out of every 100 trades, I'm more or less profitable on 94 of them. So 94 trades out of 100. That's a very consistent trader, right? 94 trades out of 100, I win on average 25 cents. So 25 cents times 94 times comes up to $23.50, right? So I've made $23.50 with an average gain of 25 cents, okay? But on the six times that I lose an entire dollar. Now my average gain is 25 cents. My average loss is $1. That's an inverse relationship. Now a novice looking at that number would say Oliver's a bad trader because when he loses $1, and when he wins, he only wins 25 cents. But here's what you're missing. I've made $23.50 winning 94 times 25 cents, losing only 6 times $1. So $3.50 is what I win, $6 is what I lose. That is extraordinarily professional. Now listen, 25 cents comes a lot more frequently than $1. So this is why the consistent trader does not want a positive ratio, because their consistency is not rewarded by what happens frequently. A consistent trader wants to be consistent on something that happens all the time. 25 cents happens tremendously more often than $1. So while the novice trader is waiting for a $1 move or a $1 gain to happen, I'm getting 25 cents, 25 cents, 25 cents, probably 10, 20 times before he catches $1. So listen to me carefully in my summary. A consistent trader wants an inverse relationship. All professional traders who've achieved consistency will operate with an inverse relationship, which means that when you see them lose, they will lose larger than their win, but they lose so much more infrequently than they win. If a trader, they have horrible consistency, then that trader needs to utilize a risk reward ratio that is positive, something like 3 to 1 or 4 to 1. They need this ratio to protect their inconsistency. So I hope that these 2 points are driven home by me. I hope you understand that risk is relative. Don't look at the dollar amount. All right? Look at ratios. Okay? My count is rather large for the average trader. What the average trader might see as big is very, very small to me. Okay? And other traders who trade on that level. That's the first thing. And the second thing is professionals typically want an inverse relationship. Novices need the positive ratio.